Your wealth deserves stability, expertise, security. Your wealth deserves LGT Crestone, private wealth with over a century of global heritage.
And welcome to the Global View on this Thursday. Well, longer-dated US Treasury yields have fallen on solid demand for a $38 billion sale of 10-year notes. This comes ahead of consumer price inflation data for July, which will be released tonight. The 10-year yield was little changed at 4.01% and the 2-year up 5 basis points to 4.8%. Meanwhile, a Reuters poll of bond strategists was of the view that US Treasury yields will fall in coming months despite the Federal Reserve's reluctance to consider rate cuts. The median forecast for the 10-year note, the yield there was 3.6% in 6 months' time. Well, the US dollar has eased against the yuan on data showing that China's economy slipped into deflation last month, raising expectations that China will come up with additional stimulus measures. The Aussie dollar trading closer to 65.3 US cents. Well, markets have transitioned to the soft landing narrative and expectations are high, says our next guest. So what should investors be thinking? Sam Ruiz joining us from T. Rowe Price. Sam, good to see you.
Hey, Andrew.
I know you say the clock is ticking for some of 2023's biggest winners. 2024 could be very different. That sounds ominous. What are you considering at the moment?
I think that we've talked last time on the show about this narrow market leadership with these big 7 companies, all been fantastic. AI narratives, multiples and valuations have been really high. I think what you talked about was this sort of soft landing narrative that's in the market right now. Let's take a pause for a moment. What's really been remarkable and surprising is all of this huge amounts of cash. We've all talked about it. Now, to give you a couple of data points here, and this will flow through to what might transition to 2024, is that by our numbers, we actually see that there was an additional $2 trillion of cash in households in the US versus pre-COVID. Now, that's now been drained all the way back to around $500 billion. So we've drained about 75% of the cash. And then there's this big talk around 30-year mortgages in the US. So we've got the 30-year mortgage rate at around 6.84%. But when we cut the numbers, the effective rate that people are actually paying is around 3.6%. Now, last time we had 30-year mortgages around 6.8%, we had the effective rates closer to 6%. So there's a real big buffer here, and the transition or the transmission mechanism of rates is not flowing through to the economy. Now, this is part of the reason why we've seen this AI buzz hype really flow through to really big valuations and extreme outperformance of these stocks. What I'd say, however, is that we're in a position now where some of the biggest market leaders, and your last presenter was talking about NVIDIA, are trading at really elevated valuations, and even some of the better known companies like Apple, until the recent result, actually went back to their COVID highs. And we're going into a period in 2024 where these companies are always performing based on market's expectation for the next 12 months acceleration. Now, a company like NVIDIA, if we think about 2024, it's going to be incredibly difficult to continue to sustain that same growth rate. And the moment the market figures that out, that really high valuation becomes incredibly vulnerable. So there's other pockets of the market in this narrow market rally where we don't see that same risk. And that's where we're spending more time looking towards 2024.
All right, so if you're in those AI leaders, you cite NVIDIA as a good example there. What do you do with your holding there?
I think with and this is where it becomes incredibly complex. So on our numbers or our expectations, NVIDIA could actually print a fascinating quarter coming up. All the anecdotes and the commentary we get from companies is that it is almost impossible to get GPUs or chips. So it shows the demand is incredibly strong. Where do you rotate to? Now, there's a couple of things that I think we need to discuss that underpin other parts of the market that could be really strong. The first one, I think we've got a really non-consensus view on inflation. Now, the market's expectation with this softer landing narrative is that inflation, we've beat it, it's dead. We've gone from 9% back to 3% and it's falling pretty quickly. The risk here is that there's some really big structural things that changed during COVID. One of them being supply chains and geopolitically, how much more difficult it is to get things made cheaply offshore, particularly in China. The other big one, and this has really big implications for the commodity complex and then where investors we think can rotate to, is actually productivity in oil and natural gas. Now, what we're actually seeing in the US by speaking to many companies over there is that all of these really big reserves that they've found, it's actually becoming much more difficult, it's taking longer, and it's more expensive to extract the same unit, particularly of natural gas, out of the ground. What does this mean? If it costs more and it takes longer, it means this actually flows through to higher costs. So cost curves move higher, and that flows through to higher prices. Now, this is really critical for two reasons. Firstly, this can flow through to commodities. Something like copper, for example, around 30% of the cost of production of copper comes from energy costs. So that pushes the cost of production of copper higher and copper prices higher. There's actually about an 82% correlation over the last 4 years of the price of copper and the price of energy prices. So it's a really big read through. The other really big implication is if we're right that it's going to start to cost more and energy costs are moving back higher.
Yeah.
We've just benefited from a really big downdraft in oil prices because China's been weaker. Also because Europe had a warm winter. Now, if that doesn't repeat and this productivity issue sustains, inflation in our view is actually going to re-accelerate, and that busts some of the narrative around why valuations have moved higher and where investors therefore need to benefit or hedge inflation.
All right, well, let's explore what you're seeing in energy there at the moment. In fact, just overnight, I mean, oil's back up to those levels we saw in January. We had sort of lower stockpiles in the US, plus of course you've got those extended production cuts from Saudi Arabia and Russia. So are you expecting then that oil price to continue rising? And further to that, just in terms of copper, where are you investing then? Are you preferring, would you be going into copper stocks, given obviously those costs are going to rise at the same time?
Yeah, we are definitely going to copper. Now, this is where costs don't mean that it means that the margins are hurt for all companies. So what it actually does is it increases the incentive price, which means that it actually is going to take more for your competitors to actually want to produce more oil, for example. That means that the low-cost, high-capacity producers actually can continue pumping out oil and natural gas at higher spreads or margins, and it's more profitable. So you need to think about who those companies are with capacity and are already there. Copper's really different. It actually takes up to 10 years to produce a new mine for copper before you're pulling copper out of the ground. Now, we've had a massive underinvestment in copper mines effectively, and we're actually seeing that coming into 2025, 2026, where demand really re-accelerates because of renewables, electrification, and the transition of energy more broadly, that we're actually not going to be even able to pull more copper out the ground when the world needs more. So it's actually very different for copper, where this should benefit most copper miners, but you then have to start sifting through the weeds on who the pure play miners are, some that have idiosyncratic issues. So we prefer the more liquid, diversified global plays.
Where specifically regionally would you be looking? Because are you looking at those developed markets? Because you've also got to bear in mind sovereign risk too, haven't you?
Correct, absolutely. So there's some issues in Chile with nationalisation. There's also a few European players where they've just had some issues such as fires in their smelters. So for us right now, there's two companies, Freeport-McMoRan and Ero Copper, effectively. So we do actually see more ability just to find some of these names, particularly pure plays in the US as well.
Interesting then, your view just as far as inflation potentially could re-accelerate. Of course, we're going to get that key CPI read out of the States tonight, but you're saying this is all coming back to those energy prices, and that's certainly a feature of speaking to a few US guests talking about the demand for energy in the States, particularly over summer, has been huge because of how hot it's been.
Absolutely. Now, this can get very deep and complex, but there was formerly a narrative in the market that we're in secular decline, and we had the same view, to be fair, of fossil fuels generally. What we're actually starting to see is more pragmatism from governments, even such as Sweden, where when energy prices are too high and that's starting to feed through to inflation, they've actually cut or reduced or paused their renewable targets. So that's something where I think effectively governments come in and say we have to actually start to protect our own households, consumer inflation, our own budgets. And that can actually completely distort some of the market's expectations for whether we're just done with energy over the long term. And I think that's part of it.
Sam, something a little different. You're also focused on healthcare. Is that a defensive play or maybe not? Are you looking for some growth there? Because I see you're actually looking at bioprocessing. Just explain, what is that?
Yeah, it might not be something familiar to most people, but this is one of the most exciting parts of healthcare. It's very well known. Effectively, when we all take drugs, there's two forms of drugs. There's small molecule drugs, which are basically chemical compounds. It's a typical pill and oral tablet that we take. But then there's biologics. Biologics are effectively, and to give you examples of biologics, there's Botox is a biologic, but vaccines are biologics, insulin's a biologic, gene hormone therapy are biologics. This is creating drugs from living cells, living organisms. Excuse me. Think about how these are made. Effectively, the same way that we brew beer, living organisms in these big steel vats, this is how we're actually producing drugs these days. And biologics are actually taking massive share from these traditional small molecule drugs. It's actually projected that pharmaceutical sales are going to go upwards of 50% sales just to biologics in the future. Why are biologics so great? They're actually able to target the impacted cells much more directly, and we're seeing massive breakthroughs in treatments for particularly cancer, which is why R&D investment, trials, and basically bioprocessing, which is actually the manufacturing of these drugs, is actually going up much higher. What happened as a result of COVID was there was this massive rush for bioprocessing because we needed to make all these COVID vaccines, which are biologics, and also all these therapeutics. What we've seen now is that resulted in huge inventory overstocking, because the moment that vaccines were basically kind of behind us, everyone had stockpiled and they didn't need to reorder a bioprocess. We're actually finding now that this incredibly exciting, well-known part of healthcare that has a decade or even plus of very long growth is actually reaching the trough of those inventories being drawn down. We're seeing evidence now that we're 1 or 2 quarters away from that re-accelerating. So one of the highest quality parts of healthcare, really fast growth, high margins, and we think that we're re-approaching that period of acceleration.
Well, and you can see that growth there with obviously chronic diseases increasing along with the ageing population. Any specific companies that you're interested in that space?
There's 3 fantastic companies globally. Very well known to investors are Thermo Fisher and Danaher, but also Sartorius is another one. Now, I'd just say for investors, what you need to think about, this isn't just about picking your most speculative small cap in this space, because what happens, which is quite surprising, is that if any of the suppliers or manufacturers of any of these biologics actually go out of business, that means that all of your phase 1, phase 2, phase 3 trials from the FDA are basically scrapped, and you have to go through all over again. So if you, for example, were someone who was trying to create a new biologic drug, you're pretty much only going to partner with some of the biggest and best where you think that there's not a risk to the approval pipeline down the path. So really, I think investors need to focus on the biggest, pure, but highest quality plays.
Sam, you give us some great investment ideas right there. Thanks for joining us from T. Rowe Price.
Thanks, Andrew.
That is the Global View for this Thursday. Stay with us. The Open, just moments away.